Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Rick Rule. He is the Senior Managing Director at the Toronto-based Sprott Inc., and he is also the President and CEO of Sprott U.S. Holdings and is the Chief Investment Officer for Sprott Resource Holdings. Rick is really well known for his success. One time when he was on this show with Doug Casey, Doug called Rick the best investor that he has ever known, and that's saying something because Doug is no slouch himself. He's done very well himself with his investing in the past. So we're very fortunate to have Rick with us again. Thanks for joining us, Rick.
Jay, it's a real pleasure. Thank you for having me.
It's always good to have you with us. Your advice, your ideas, they're novel, they're your own, and they're not warmed over pablum as we get from so many people. Not on this show, but on the other shows, on the main channels, of course. I want to ask you a little bit about Sprott Inc. Trades in Toronto, trades in the U.S. as well. How's the company doing? Could you talk a little bit about the Sprott business model, just for people that might not be familiar? What does Sprott do, and how do they make money? Because they are profitable. They're even paying a dividend, I think, not too far under 4%, which is pretty good these days for a stable company. So just talk to us a little bit in general about Sprott and its business model.
Sure. Sprott is an investment manager and an investor in natural resources and precious metals. We manage or administer about $14 billion of capital on behalf of about 200,000 investors worldwide. Unlike many investment managers, we don't try to cover the entire investment horizon. We have been for 40 years specialists in natural resources and particularly in precious metals. As you point out, in the bear market that we just went through, where the most relevant of indexes, the Toronto Stock Exchange Venture Resource Index, fell by 88% in nominal terms, we managed to stay profitable. Not always easily, but we did. And I would say that we are respectful enough of our owners, the shareholders, that we continued to maintain a dividend through that entire period. That dividend, as you point out, is now approaching 4%. Our mutual friend, Doug Casey, describes dividends wonderfully as outward manifestations of inward grace. The fact that we're able to pay a dividend speaks to our financial health, and the fact that we're willing to pay a dividend, I think, speaks volumes of the regard that management has for the owners of that business.
Right.
It's my belief that we have one of the most valuable brand names in the world related to precious metals investing. And if I am right, that we are early on in a precious metals and precious metals equities bull market, my hope would be that the relationship that we enjoy with 200,000 investors worldwide gets deeper and more profitable for both. And that will be reflected first in the income statement, then in the balance sheet, and of course, finally in the share price of Sprott Inc.
Well, certainly you mentioned brand name. Sprott is, of course, named after Eric Sprott, the well-known investor in the Canadian mining sector. And I see Eric's name involved with private placements in countless junior mining companies that I follow, write about, and invest in myself. To what extent, if any, is Eric still involved in the activities of Sprott? I know he's doing his own thing to a great extent, but is he involved at all directly, formally with Sprott or informally?
Eric is no longer an officer or director of Sprott, so he isn't bound in a compliance sense with us from the point of view of securities industry regulators on either side of the border. Eric is, as far as I know, still our largest private client, and he's still a very substantial shareholder. I would describe us as good friends, but no longer joined at the hip. much of the way in which Eric has built his fortune, and he continues to speculate today, is appropriate for him or appropriate for me. That is, it's appropriate for knowledgeable, wealthy clients who can afford the outsized risk
Yes.
that is inherent in mineral exploration. Some of those activities are not appropriate to some of the 200,000 investors that we represent worldwide who might, as an example, want a more efficient way to hold bullion through Sprott, or to the institutional investors that participate in our lending business, which is a relatively high return but much lower risk business. So much of what Eric does, he does unconstrained by considerations of how the risks that he's willing to take might impact others.
Well, Rick, maybe you could just talk for a minute about just specifically what are some of the services. You mentioned the bullion. I guess you could certainly buy the Sprott Bullion ETF. You have a silver one and a gold one as well, I believe. And also then you have a mutual fund, I think, a gold share mutual fund, gold mining share mutual fund as well. Maybe you could just talk about those other things that provide a lower risk profile for the average investor.
The three products that we're known the best for are the Sprott Physical Gold Trust, the Physical Silver Trust, and the Physical Platinum and Palladium Trust. And they are often superior products for U.S. taxpayers because unlike the conventional ETFs like GLD, the precious metals that we hold on behalf of our investors is not regarded by the IRS as a surrogate for physical gold ownership, but rather represents shares in the trust. The important difference there is that on disposition, if the investor has generated a capital gain, that capital gains in the Sprott product is taxed as a capital gain rather than as ordinary income. Which is what occurs in the ETF. Being the sort of patriot that you are and I am, Jay, the idea that we pay them less is at once practical and patriotic. So for U.S. taxpayers, the Sprott product may have very, very substantial advantages. Secondly, unlike the conventional ETFs, which gain or lose assets every day depending on the whims of the markets or the investors, and therefore have to buy or sell precious metals every day. In the Sprott trusts, we occasionally raise relatively large sums of money and invest that money simultaneously in physical metal, which is deposited at the Royal Canadian Mint. The benefit of that is that we never accept depository receipts, but only physical metal.
Good.
So we are never the unsecured creditors of a counterparty in a transaction, unlike some of the ETFs where fears have been expressed as to the nature of their inventory during periods of rapid metals price increases.
Very interesting.
The other products that we have are gold mining share ETFs. We have a senior gold miners ETF and a junior gold miners ETF. Unlike the other ETFs, ours aren't purely market cap weighted, but are rather factors based. In particular, one of the factors that governs our own selection is revenue growth. Because one of the risks that you have in gold mining companies is that to the extent that you're not replacing your reserves, your business is shrinking. And we didn't want to own large amounts of large rotting businesses, but rather we wanted to own businesses that would continue to benefit from the upside in gold. We also recently acquired a longtime friend and competitor of ours, the Tocqueville gold assets managed by John Hathaway, who, as I say, we have competed against for 20 years. But have come to be very fond of. So for those people who want active management, we have both an actively managed mutual fund and also a special segregated account managed by Hathaway and his team and our team, which buys shares in companies that we believe are takeover targets in the consolidation wave, which is, as you've noticed, sweeping the mining industry.
Yeah, it's starting to happen. I wonder to what extent you think. Maybe before I get to that question, you're bullish on gold. Just to lay out the reasons why.
Well, for the reasons you.
Or do we have enough time?
Yeah, we really don't. I mean, gold is, again, as our friend Doug Casey points out, both a medium of exchange but a store of value. Unlike a fiat currency, which is classically a promise to pay, gold is in and of itself payment. It is not an obligation of the payor. It is, in fact, payment itself. The knock against gold was always that there was a cost associated with holding it. That cost being the yield that somebody had to give up by owning, as an example, gold rather than treasuries. Mm-hmm. With the current treasury yield, that's less of a problem. Our mutual friend Jim Grant describes sovereign debt these days as return-free risk. Yeah. And if you think about that slogan, that says something about gold's competition. Mm-hmm. In fact, now, Jay, there's almost $20 trillion in government obligations worldwide, where for the first time in my career, governments will tell the truth. They are promising that if you loan them money, they will give you back less than you gave them. And they will keep that promise. I think in that context, gold ownership for most people, particularly older people who don't have a chance to get back what sovereign debt might steal, that gold ownership is in fact a must.
Mm-hmm. Oh, for sure. So do you feel that we've had quite a run in gold already. Michael Oliver, who we have on this show, believes we're in a congestion period now. He thinks we probably need to see a couple of different markets head in the opposite direction, probably the equity markets and or the dollar market, for the next real major move in the gold markets to take place. He's looking for at probably a resistance area somewhere around 1,700 once we get the next move underway. Does that seem outrageous to you?
I'd need to caveat my response, Jay. I'm a credit analyst. I'm not a market technician.
You're just a humble credit analyst.
I am. I'm a loan shark, really. And I can't really tell you what gold's going to do in the near term. When I hear people describe the fact that gold has already had a major move, a major move to me is a move like the move I saw in the 70s.
Yeah.
From an admittedly price-controlled $35 to $850. Or a move like we saw last decade, where gold started out at the beginning of the decade at $250 and ended the decade at $1,900. I, in fact, have used as a marketing prop a graph. Admittedly, I'm no technical analyst, but this is the 40-year gold mining stock index rather than a gold chart that shows the longest running mining index that I'm familiar with. And there are three parts of the chart that are particularly instructive to me and I think would be instructive to your readers. Mm-hmm. The first is that when you look at where gold is today, or gold mining stocks, relative to where they were over the last 40 years, it is crystal clear that we are either approaching the bottom, at the bottom, or just off the bottom on a 40-year basis. That much is very clear. Mm-hmm. The second thing that's clear is that these troughs, these mining index declines, last between sort of 2 years and 5 years. So this decline is extremely long of tooth. Mm-hmm. It would appear from a historical perspective to be at the end or very close to the end. Mm-hmm. The most dramatic part of the chart, however, is the violence of the upside in recoveries. Mm-hmm. An anemic recovery generates a 200% response in the index. Mm-hmm. A real recovery generates 1,000 or 1,200% response. The important thing I think that you get from this is that even if we had a year or a year and a half or 2 years of sideways performance from the gold stocks, and we had to charge ourselves rent on our capital over a year or 2 years, the magnitude of the recovery in the short period of time over which it takes place means that almost any rent you had to pay on your holding period when gold was going sideways was irrelevant compared to the ultimate return. And that's what I would rather draw people's attention to.
Well,
I don't know what the upside is because it's difficult for me to fathom the level of collective stupidity that we engage in politically. And I really believe that the ultimate determinant of the gold price, and hence gold equities prices, is a function of the lack of confidence that will ultimately be expressed by savers in the purchasing power, particularly of the U.S. dollar, and particularly of the U.S. dollar expressed by the U.S. 10-year Treasury. My confidence is low, of course.
Yeah, well, I think we share that level of confidence or lack of confidence. Rick, I think I've seen that chart you're referring to of the equity market, of the gold share markets. And I think, as I recall, though, there is also, there's a prolonged period of bull market, and then you have a period where you might lose about 80% in a fairly short period of time. And you have always been, one of the reasons you've been so successful is you've not been too greedy. You're willing to get out before and not take the last dollar off the table. And so, the one question I want to make sure I ask you today is how will we know when it's time to exit? I'm not suggesting that we should be thinking about exiting. I agree with you. I think we're in maybe the second or third inning of a 9-inning game. So, but what will you be looking for to say, Rick, it's over, Jay, it's over, you got to get out of this thing now because it could, it's long in the tooth, and we don't want to lose 80% or 90% of what we've gained.
When the Jay Taylor channel has 1 million subscribers, and when Sprott Inc. is selling for 30 as opposed to 3, and when you and I come to believe that gold is no longer cyclical or volatile, that is, when we become confident, when the cover of whatever they call Business Week magazine now has a bunch of bullion on it, when what we do becomes respectable, it will be time for you and I to fashion our last exit.
Well, that's right. Gold is still not respectable, even though there are some big name investors that are supposedly investing in gold. It's still not a respectable thing to do, is it, Rick, to own gold?
It isn't. And I hope that most of your readers understand that gold in its most fundamental form as an investment is really an insurance product.
That's right.
It does well when other parts of your portfolio punish you. And the good news is that a relatively small premium can provide a lot of insurance to you.
That is the good news. So when it's time to get out, Rick, we're going to be looking for other places, and I know you'll be looking for other places, although, I don't know, I think I heard you say something about this is your last rodeo or something like that. I can't believe that. You're not nearly as old as I am.
What I will begin to be more active doing, Jay, is merely managing the account of the investor that I know best, who is myself. I will almost certainly share the benefit of my work with anybody who cares to avail themselves of it through Sprott. But I see myself increasingly wanting just to manage my own money and to increasingly divorce myself from the regulatory environment that I find myself in.
No, I can't blame you at all for that. Just a couple of more questions. We're almost out of time here, but what do you make of this negative interest rates that we have around the globe? You've got I saw something like 94% of all investment-grade bonds are U.S. dollar denominated. It seems as though there's pressure for interest rates to continue to decline. And, our good friend, I think you know Alistair MacLeod. He's been on my show many times. And Alistair really makes the point that there's a difference between the U.S. dollar's negative interest rate and the negative interest rates of, say, the euro or the yen, because everything in the world is denominated in U.S. dollars. And when that time preference, that concept of time preference, where gold has a time preference of 1.5 or 2%, something like that. That's what the markets are telling us. That when the Treasury markets go below that, and that's pretty much where they're below that now, there's no reason to own currency anymore. And so he thinks that may be the death knell of the dollar as the world's reserve currency. Any thoughts along those lines with about a minute left?
I don't think that we're going to see in the near term the demise of the dollar as the world's reserve currency. Mm-hmm. Doug Casey says it's the prettiest mare at the slaughterhouse. And we just aren't competitive in terms of devaluing our currency, as competitive as other countries are. Mm-hmm. I don't think that gold will win the war against the U.S. dollar. I just think it'll lose it much less badly. Mm-hmm. So I would advise people to hold some liquidity in dollars and some liquidity in gold. It's just that most people hold almost no liquidity in gold, which is an enormous mistake. I see the U.S. dollar being strong relative to other fiat currencies for the next year and a half or 2 years. I think that gold will be simultaneously strong. And then I think you'll see a circumstance like you saw in 1976 and again in 2002, where the dollar begins to roll over and gold does very, very well.
Mm-hmm. That could be the peak of this cycle, perhaps. Well, Rick, I want to thank you very much for spending your time with us. Always good to hear from you, and your wisdom is cherished by our listeners. I know that's true. So thank you very much for being with us.
Jay, a pleasure. I look forward to doing it again.
All right. We'll most certainly will.